The market looks calm on the surface, but underneath it, something massive just changed. In the last few days, the Federal Reserve quietly flipped a switch that most retail investors don't fully understand yet. And historically, whenever this switch is flipped, stocks don't behave normally anymore. This is not hype. This is not a conspiracy. This is a pattern that has repeated again and again over the last 2 decades. The Fed has effectively started another stock market bailout, and if you don't adjust your strategy right now, you risk being on the wrong side of one of the most manipulated markets in history. Let's start with what actually happened. The Federal Reserve didn't come out and say, "We are saving the stock market." They never do. Instead, they used technical language, balance sheet tools, and liquidity operations that sound boring but have explosive consequences. Liquidity is the lifeblood of financial markets. When liquidity dries up, stocks crash. When liquidity floods in, stocks levitate, even if the economy looks weak. Right now, liquidity is coming back in a big way. Over the past months, we saw rising interest rates, quantitative tightening, and a lot of fear. Banks were stressed, bond markets were breaking, and volatility was creeping in. Then suddenly, things changed. The Fed slowed down tightening, injected emergency liquidity through backdoor facilities, and signaled that financial stability matters more than fighting inflation at all costs. This is the same movie we've seen before. Different year, different excuse, same ending. Here's the key point most people miss. A stock bailout does not always mean the Fed is buying stocks directly. In fact, they almost never do. Instead, they stabilize the system around stocks. They support banks, backstop bonds, and flood short-term funding markets with cash. When banks feel safe, they lend. When funds feel liquid, they buy risk assets. And when risk assets start going up, retail investors pile in at the worst possible time. Think back to 2008. Think about 2020. In both cases, the economy was collapsing, unemployment was exploding, and fear was everywhere. Yet stocks bottomed and went on historic bull runs. Why? Because the Fed stepped in with unlimited support. They printed money, expanded their balance sheet, and made it clear that markets would not be allowed to fail. That is the real Fed put. Now fast forward to today. Inflation is still sticky. Growth is slowing. Consumers are under pressure. Corporate earnings are shaky. By all logical standards, stocks should be struggling. But instead, dips are getting bought aggressively. Volatility refuses to stay high. And the biggest stocks keep marching upward. That is not natural price discovery. That is liquidity at work. So what exactly did the Fed do this time? First, they effectively paused the pace of tightening. Second, they opened liquidity facilities that allow banks to swap troubled assets for cash at favorable terms. Third, they softened their language. Markets trade on expectations, not reality. When investors believe the Fed will step in if things get ugly, they take more risk. That belief alone pushes prices higher. This is why calling this a stock bailout is accurate, even if it doesn't look like one on the surface. The Fed is not rescuing individual companies. They are rescuing the system that supports asset prices. And when the system is protected, stocks benefit disproportionately. Now here's where most people get this wrong. They hear bailout and think, great, time to go all in. That mindset destroys portfolios. The Fed creates opportunity, but it also creates traps. When liquidity returns, the first move is often sharp, fast, and emotional. Late buyers chase. Smart money distributes. Volatility spikes when everyone is positioned the same way. So what should you actually do now? First, you need to accept reality. Fighting the Fed is a losing game. If liquidity is increasing, you want exposure to assets that benefit from liquidity. Historically, large cap growth stocks, indexes, and quality names with strong balance sheets outperform in the early phase of a Fed-driven rally. Speculative junk may pump later, but it also collapses the fastest. Second, risk management matters more than ever. A bailout-driven market is not a healthy market. It is fragile. It can reverse quickly if inflation re-accelerates or if the Fed changes tone again. That means position sizing, stop losses, and diversification are non-negotiable. This is not the time to bet your entire portfolio on one idea. Third, watch the bond market like a hawk. Bonds usually sniff out trouble before stocks do. If yields start spiking uncontrollably or credit spreads blow out, that's a warning sign that the bailout is losing effectiveness. On the other hand, stable yields and narrowing spreads confirm that liquidity is working its way through the system. Fourth, understand the timeline. Fed bailouts don't last forever. They buy time. They kick the can down the road. Eventually, fundamentals matter again. But that, eventually, can be months or even years. Your job as an investor is not to predict the exact end. Your job is to adapt while the rules of the game are temporarily changed. Let's talk psychology, because this is where most investors fail. When markets rise during economic weakness, it feels wrong. People hesitate. They wait for confirmation. By the time the rally feels safe, most of the gains are already gone. At the same time, fear never fully disappears. Every pullback feels like the start of a crash. That emotional whiplash causes people to buy high and sell low, over and over again. The Fed knows this. They rely on confidence. Confidence keeps the system functioning. If asset prices collapse, confidence collapses, and the economy follows. That's why the Fed always chooses market stability over short-term pain. Politicians may talk tough, but when push comes to shove, the money printer always wins. This doesn't mean stocks go straight up. Expect violent rotations. Expect sudden sell-offs on bad headlines. Expect social media to scream, crash, every other week. That noise is part of the process. Underneath it all, liquidity quietly does its job. Another critical point most people ignore is inflation. Bailouts are inflationary by nature. Even if consumer prices don't explode immediately, asset inflation almost always does. Stocks, real estate, and hard assets tend to absorb excess liquidity faster than wages or goods. That's why staying entirely in cash during a bailout phase can be a hidden loss. However, blindly chasing the hottest names is just as dangerous. The goal is balance, exposure without recklessness, participation without euphoria. This is how professionals survive manipulated markets. So let's be very clear about the message. The Fed just signaled that markets matter more than discipline. That is bullish in the short to medium term, but dangerous in the long term. You can make money in this environment, but only if you respect the risks and stay flexible. If you do nothing, inflation and asset moves will do something to you. Cash will lose value, volatility will punish indecision, and emotional reactions will slowly drain your account. Doing nothing is still a decision, and in a Fed-driven market, it's often the worst one. The smartest move right now is awareness. Know that this rally is not organic. Know that it is supported. And know that support can be removed faster than it was added. Align yourself with liquidity, manage your downside, and don't let headlines control your strategy. This is exactly why smart investors watch the Fed more than earnings, more than news, and more than opinions. The Fed sets the rules. Right now, the rule is simple. Liquidity is back, and markets are responding. If you want to survive and thrive in this environment, stop thinking like a long-term economist and start thinking like a risk manager. Respect the bailout, but don't worship it. Use it, don't marry it. Because when the Fed changes its mind again, and it always does, you want to be the one taking profits, not the one providing liquidity to someone else's exit.